Before we get into today's video, I want to ask you a simple question. How many times have you heard someone say, "I'm just waiting for the crash"? Maybe you've said it yourself. The market hits all-time highs, headlines warn of recession, analysts predict disaster, and suddenly everyone starts believing that the safest move is to sit in cash and wait for the perfect opportunity. But here's the problem. The perfect opportunity almost never looks obvious when it's actually happening. And the biggest mistake investors make isn't necessarily buying at the wrong time, it's doing nothing at all. Because while people are busy waiting for certainty, the market often keeps moving higher. And that's exactly why we built what we believe is the most powerful strategy we've ever created. Now, this isn't a get-rich-quick system. It's not magic. And it's definitely not a strategy that guarantees you'll never lose money. Instead, it's a framework designed to answer one of the hardest questions every investor faces. What should you actually be doing right now? Should you be aggressive? Should you stay invested, but cautious? Or should you step aside and protect your capital? Instead of relying on emotions, opinions, or whatever headline happens to be trending that day, we wanted a process rooted in data. Because when you look back throughout history, one thing becomes very clear. The economy leaves clues, the market leaves clues, and investors who know how to interpret those clues often make much better decisions than those who react emotionally. Think about the warning signs we've seen before major downturns: the yield curve inverting, unemployment beginning to rise, housing activity slowing, credit conditions tightening, corporate profits weakening. None of these indicators are perfect by themselves, but together, they tell a story. The challenge is that most investors either ignore these signals entirely or become obsessed with just one indicator. If the yield curve inverts, they panic. If unemployment ticks up slightly, they assume a recession is guaranteed. If the market rallies despite negative headlines, they dismiss the risks altogether. The reality is much more complicated. No single data point predicts the future with complete accuracy. That's why we spent years asking a different question. What if we could combine multiple indicators into one system? What if instead of relying on gut feelings, we created a framework that adapts as conditions change? A framework that doesn't care about politics, doesn't care about social media opinions, and doesn't care about fear or greed, only the data. Because history teaches us something fascinating. Even during periods filled with uncertainty, markets tend to reward disciplined investors. Take the periods following major economic scares. There were moments when recession fears dominated the headlines. Experts warned of catastrophe. Investors moved to cash expecting the worst, yet the market continued climbing. On the other hand, there were also periods when everything looked perfectly fine on the surface. Employment remained strong. Consumer confidence stayed elevated. Stocks continued hitting new highs. And then suddenly, conditions deteriorated much faster than anyone expected. The truth is, the economy rarely sends simple messages. That's why reacting emotionally can be so dangerous. Fear causes people to sell near bottoms. Greed causes people to chase near tops. And uncertainty often causes people to freeze completely. But a systematic approach removes much of that emotional burden. It doesn't eliminate uncertainty, nothing can, but it provides structure during moments when emotions are strongest. So what does that actually look like? At its core, our strategy simplifies the market environment into 3 different signals. The first signal is aggressive. This occurs when economic and market conditions align in a way that historically favors stronger risk-taking. Growth is healthy. Liquidity conditions are supportive. Leading indicators suggest momentum remains intact. During these environments, being overly defensive often means missing significant upside. The second signal is moderate. This is the middle ground. Conditions aren't bad enough to justify abandoning the market, but they aren't strong enough to justify maximum aggression either. It's a reminder that investing doesn't have to be all or nothing. Sometimes the smartest move is simply maintaining exposure while managing risk responsibly. Then there's the third signal, cash. And this isn't driven by fear, it's driven by evidence. When enough indicators begin flashing warning signs simultaneously, preserving capital becomes the priority. Not because we're predicting the exact day a downturn will begin, but because probabilities have shifted, and risk management matters just as much as return generation. One of the biggest misconceptions about investing is that success comes from always being invested or always being defensive. But history suggests otherwise. Markets move through cycles, economic conditions evolve, and strategies that adapt tend to outperform strategies built on rigid beliefs. Think about it this way. If you're driving cross-country, you wouldn't use the exact same speed regardless of whether the road ahead is clear, covered in rain, or blocked by heavy traffic. You adjust, not because you're afraid, but because conditions changed. Investing works the same way. The goal isn't to predict every twist and turn perfectly. The goal is to respond intelligently as new information emerges. And perhaps the most important lesson we've learned through building this strategy is that discipline beats prediction. You don't have to know exactly what happens next. You don't need to forecast the next recession with pinpoint accuracy. You don't have to guess whether the market will rise 5%, fall 10%, or move sideways. What matters is having a repeatable process. A process you can trust when emotions run high, because emotions are expensive. Fear convinces people that this time is different. Greed convinces people that risks no longer exist. Both can destroy years of progress. But discipline creates consistency. It allows investors to participate when opportunities are favorable and become cautious when risks increase. Now, does this mean our strategy will always be right? Of course not. No strategy is. There will be false signals, unexpected events, black swan moments that nobody could predict. That's simply the reality of investing. But perfection was never the objective. The objective was to create something better than emotional decision-making, something better than chasing headlines, something capable of navigating uncertainty with logic instead of panic. And after years of research, testing, refining, and learning from history, we genuinely believe this is the most powerful strategy we've ever built. Not because it's flashy, not because it promises impossible returns, but because it acknowledges one simple truth. Nobody knows exactly what comes next, yet investors still have to make decisions, and those decisions become much easier when they're guided by evidence instead of emotion. The market will continue surprising people. There will always be another scary headline, another recession prediction, another reason to wait for the perfect moment. But the perfect moment rarely arrives. What does arrive are opportunities, risks, changing conditions, and the choice to approach them with either emotion or discipline. We know which approach history favors. Thank you so much for watching. If you enjoyed this video and found value in today's discussion, make sure to leave a like and subscribe for more data-driven insights on markets, investing, and the economy. And remember, successful investing isn't about predicting the future perfectly. It's about building a process that helps you navigate whatever the future brings. We'll see you in the next one.